Thank you for joining us. This is the Traders Exclusive Live Trader Showcase. I'm Sherry. Please check out tradersexclusive.com, where we regularly post articles and video clips with valuable trading tips and techniques. So before we get started, I will share the quick disclaimer. You should carefully consider whether trading is suitable for you in light of your circumstances, knowledge, and financial resources. You may lose all or more of your initial investment. Opinions, market data, and recommendations are subject to change at any time, and past performance is not necessarily indicative of future results. Many thanks to our sponsors for the June Live Trader Showcase, Market Taker Mentoring, TechniTrader, and Money Mentor. Please go check them out at markettaker.com, technitrader.com, and moneymentor.com. Thank you again. Michael Guess of Day Trade Safe is here with us. He's going to talk to us about stop the losing and finally be a consistent winner 87+% of the time. So welcome, Michael. I appreciate you being with us.
Well, thank you very, very much there, Sherry. And of course, to Traders Exclusive. All right. And thanks all of you for being here today and taking time out to join us. I am Michael Guess. I'm the president and CEO, as she said, of TradeSafe, and that is daytradesafe.com. And I'm going to just make this comment once at the beginning. We don't have enough time to go into all the details of what the TradeSafe system is capable of, including real live charts with trades, which is what everybody loves to see. What instead I'm going to do is give you the overview of how it works. And I'm going to direct you might want to jot this down, folks. Go to daytradesafe.com/replay. And then you can watch a much lengthier presentation that does include what I wasn't able to include today. So with that being said, I want to focus on how you can actually achieve the Holy Grail. I know that term gets thrown around a lot, but it's the real Holy Grail, not rocket science indicators, it's consistency. Because if you don't have consistency in your trading, then you aren't going to be able to make it. Run it like a real business. And in order to do that, you're going to have to replace your subjective, discretionary trading with real, consistent winning results. That means a true mechanical trading system. So, once again, let me introduce myself. That's me. I want to thank you for being here. And what I want to do is just comment briefly. We've got a lot of volatility in today's markets, and I'm a day trader. And of course, I'd say probably most of you are, if not all of you. And given the global conditions today, and certainly the political environment, I won't even comment on that, it's definitely caused the markets at a day trading level to be very volatile. So you get a lot of inconsistency. How do you overcome that? I'm going to show you how to filter out the volatility and smooth out that uncertainty that has been bothering you. Now, the first thing I want to mention is stop trading with a single chart. Don't do that. That's what amateurs do. You need multiple charts with higher and higher settings, and not just the generic ones that are in the drop-down menus from your trading platform. You need to be able to choose very specific settings. So I know some of you like to use Thinkorswim, and I'm personal friends with the guy that created it before he sold it to TD Ameritrade. And it's really an options trading platform with a little bit of day trading grafted on. So if you're serious about your day trading, you want to migrate to a professional grade platform. I don't get paid to say it, but we use NinjaTrader. So you can dial in whatever time frame you want, because I'm going to give you a lot of these settings and many of the other things and rules that are part of our system for you to go try out without even having to have our system. Because I want you to get interested and then say, yeah, maybe if I had the system, which is, by the way, nearly fully automated, you will not have any problems with where do I get in? Where do I get out? So let's start with multiple time frames. They must be cycles based. You have got to have what is called trend agreement. What do I mean? Well, everybody's got a trend indicator. Our system actually has much more than a trend indicator. It also indicates true congestion, rules-based, not just 3 or 4 bars or something like that sideways, because that's very subjective. You're going to want to be able to know whether you've got a real trend, whether you've got real congestion, and so forth. But it's more than that. You need to know how many of these charts are trending together. You want literally back-to-back trending. You want the wind at your back, because the more charts that are trending together, up or down, the more follow through you're going to get. And the chart settings that you select are going to depend really on how long the session is in the daytime where all the trading occurs. So if you trade something like the indexes, well, Central Time in Chicago, it ends at 4 p.m. or East Coast 5. If you trade the stock market, which I don't recommend because it's really rigged with high frequency program algorithmic trading, I would rather you consider futures and commodities. But the vast majority of day traders do tend to trade them. So I hope I'm not preaching to the choir. But what I'm teaching you today is going to work on any trending market. I don't care if it's even Forex, which is not well suited for day trading. It's better suited for swing trading. But if you trade the stock market, despite what I said, or if you trade futures and commodities, this approach will work. And here's a little bonus. My method can be repurposed for swing trading. Yeah, I don't like overnight exposure, just like you don't either. But, if you've got multiple tools in your toolbox, my method will allow you to get into a low risk surgical entry position. Let me untie my tongue and get into a day trade at a very small risk. Take your profit, pay for the trade, stay in the trade, and if you're not taken out by the close, then you have a good till cancel stop. And you know what? You can trail an automated stop on a higher setting chart than the one you entered on, and that will keep you in the trade for multiple days. Now, I can talk to you about that. You can talk to me personally. I won't have any pitch or attempt to try to convince you of anything. I encourage you to send an email if you want to talk to me and get questions answered. Go to support@daytradesafe, all one word, .com, support@daytradesafe.com, and say, hey, I want to talk to Michael. Okay, let's keep going. What are I think the best markets that are typically trendy because it's easier to follow a trending market than any other type? Well, the indexes and the currencies are two great candidates. You want to avoid the congesting type markets. I know gold and crude are sexy to a lot of people. But the truth of the matter is that the majority of the time they do tend to congest. And sure, they may eventually get to where they're going, but sometimes by hook or crook, they'll have a breakout and then a fake out, and you'll get stopped out. So you want to select markets that are inherently trendy. Don't be married to something that somebody said, oh, this is really what you ought to be trading. Trade trendy markets. They have personalities, just like you and I have personalities. Markets are not all the same. So if you're going to trade the indexes, right away, I'm giving you some freebies. For a wide angle view of what the market is doing for either the whole day or at least the half day, use a 9-minute chart setting. I know that's an oddball number. That's why I said you need something like a NinjaTrader in order to do it. However, you will want that to give you an overall perspective of what the capabilities of the day might become. 300% down on dropping down to the next smaller time frame would be a 3-minute chart. That's your dominant cycle. But you want to enter on the lowest possible risk, don't you? So 300% further reduction in setting is a 1-minute chart. I know that's noise, but don't worry. We're having the wind at your back with other charts that overcomes that noise. So that is your low risk surgical entry. But even then, with today's volatile markets, folks, Sometimes you're going to see huge risk levels. I have seen $600 and $800 risk levels on a 1-minute chart for the NASDAQ. Yeah, of course, the NASDAQ is like a ferret on speed, but we all know that. What do if the 1 minute has too much risk? You can drop down to a tick-based chart. Use tick charts. If you don't know what I'm talking about, I can explain it to you when you give me a call. But tick charts have a smaller average true range, and that means your risk is smaller. But if you're going to trade a tick chart, it still needs to agree with the trend on it, at least the 1 and the 3. Now I'm going to give you a little rhyme, a mnemonic to help you remember it. The 1 and the 3 need to agree, best as if all 3 agree, and I'll tell you why in a few more minutes. But if you take a trade on a tick chart, it still must agree with at least the 1 and the 3. And the more charts that are trending together, the more follow through you can anticipate. This is going to give you what you need to know to pre-select what? Your exit strategy. You don't want to use the same default exit strategy for every trade. It all depends on how many charts are trending together. You may have a weak trend or a strong trend. So I'll explain that as we continue. So this business of high risk, I mentioned volatility gives you typically higher risk. So yes, you're going to want to switch to a tick-based chart instead of a 1-minute chart. I told you what to do. You still must make sure that the 1 and 3 are still trending together, and so must the tick chart. But you will want to do this. If only the 1-minute and 3-minute charts are trending together, that's a relatively weak trend. You should scalp. And since baseball season is on, I'll use a baseball metaphor. Just bunt and get on base. You want a high probability of reaching your target. With our system, we're well above 90% hitting the target when we scalp. So, do you like that? Keep listening. But if you've got a lot of wind at your back, all 3 agree, you want to swing for the fences. And that means you should elect a scaling out exit strategy. Some of you may not know what that means. I'll explain it in a little bit. But the point is, when you enter the trade, here is something our system does automatically to give you a little bit of a hedge, an extra protection. And that is, you want to be able to have your stop move, that's a cancel and replace, to where you entered, break even, and an additional tick of profit. So it's no longer a protective stop, it's a profit stop. So that way, if it touches your target but doesn't get the fill and comes all the way back, you don't let that winner turn into a loser. It's real frustrating and hard to take the next trade, right? So our system has an algorithm that does it on all our exit strategies because we have multiple exit strategies for different conditions. So if you're gonna scalp, remember it's all of your position in and the same amount all out. No problem there, real simple. But with scaling out, for those who don't know what that means, you have an easy to reach target and ours is already set. We've got 2 different scale out target levels, depending on how strong the trend is. You want to take off half of your position. So you need to be trading with multiples of 2, 4, 6, 8, and so on. That's divisible by 2 in order to take off half of your position, take that money off the table, put it in your pocket, you paid for the trade, and then begin trailing a stop. And in our system, guess what? That trailing the stop is fully automated. Yeah, that's right. You don't have to guess where to get out. Neither do you have to guess where to get in, as I'll be explaining in a few more minutes, because it's all rules-based to get into the trade. And the moment you press that enter button, or park the order rather, don't ever enter on market orders, by the way. Use stop limits to eliminate slippage. But I'll get to that in a moment. So Here are the 4 basic steps that we use to enter a trade-safe trade. First, determine the strength of the trend. How many of those charts are trending together? That's going to dictate which of the exit strategies you use for either scalping or scaling. Then you are looking for the setup for the actual trade, which is a rules-based pullback or retracement. Now, I know pullbacks have been around forever. They're as old as dirt. But the truth of the matter is that all the frustration you may have had about, oh, that pullback, I got in and then it went further and stopped me out. I can't say we've totally eliminated it, but we've reduced it almost to vanishing point because it is rules-based. It has real strict requirements and it gives you moment by moment feedback about what conditions are being met. So that's your setup bar, the last bar in that pullback. So if you're in an uptrend, it's going to turn around and give you a brief counter trend pullback, and it's going to go to a 21 period moving average, very common. Doesn't have to touch. I'll tell you more about that later, but ideally you would want that. But I don't put all my eggs in that basket. I want some independent, uncorrelated confirmation that is going to come from an oscillator. Now, ours is a custom built oscillator. You can pick whatever you wish, but it simply needs to go into either overbought or oversold, depending on what direction the trend is going. And no, it does not put you in the trade, folks. It's just there for independent confirmation to let you know that that retracement has probably reached its maximum point of excursion. Doesn't that make sense? Yeah, I hope so. So you are 75% of the way there. What's the last thing you do before you actually pull the trigger and park the order? You want to make sure that the risk is within bounds, within the limits that whatever your requirements are. And I'll tell you what our risk levels are in just a little bit. So step by step, I'm going to take you along. Those are the 4 steps. And I'll even tell you when to park the order to get that best moment of entry. Okay, because I told you already, don't use market orders and chase the market like amateurs do. So entry steps must have precision. Here are the 4 steps graphically represented from what I just said previously. Make sure you got that trend agreement. At least the 1 and 3 need to agree. Best as if all 3 agree. You want to pull back plus or minus X number of ticks from the 21, ideally touching it. You want it to be crisp and direct, not meandering around. You want independent, uncorrelated confirmation from an oscillator. It doesn't put you in the trade. Once it's gotten in, overbought or oversold, it's satisfied its condition. And lastly, the risk level must be within bounds before you park the order. So let's look at step 1 again. Determining strength with the indicator. You're going to do it on each and every chart. You want to look at one market at a time. Don't try to be hopping around from market to market to market, because my past as a psychotherapist and a neurophysiologist, I learned the hard way that your brain just can't process all that and make good use of it. You want to be in sync with what you're looking at. Consequently, if you find a market in whatever workspace you're looking at, maybe it'll be the Dow or the Russell or the NASDAQ, for example. And by the way, I don't recommend the ES. Why? I know everybody says that's what you should trade, but don't, because the institutions have ruined it with high frequency programmed algorithmic trading. So stay away from the ES. Use the other 3. All right. You got to find out how many of your charts on any of those markets are trending together. If the 1 and 3 agree, stay put. And then you can start looking for that pullback. You will pre-select before the pullback occurs. You've still got loads and loads of time. There's no stress. Don't be in a hurry. You can just wait for the pullback, but first preload that exit strategy. If based on what I've told you so far and on a lengthier presentation in the replay I've told you at the beginning, and it's already done for you in our system anyway, you will pre-select an exit strategy that's automated. That means you don't have to guess where to get out. It will do it for you. The scalp, all in, all out, the scale, it will hit the target, take half out, and on either one of those, it's going to always move your stop to break even in one tick of profit based on an algorithm. And if you're scaling and you do take off half your position, you just trail a stop, letting the indicator do it. It attaches your stop automatically to the indicator that we use. Now, this is all based on the strength of the trend. This is a real important key, folks. Don't just look for trends, it's how strong it is. So next comes the actual setup itself, the pullback, the retracement. I'm going into more detail on what I said before. It's a brief counter trend pullback to a 21 period exponential moving average. The setup is going to be the bar that is the furthest or deepest in the pullback. Now we have further requirements in our system. You got to have a minimum number of bars. You don't want it to spike down in just maybe 1 or 2 bars because that's not normal profit taking. You want it to be the normal type of profit taking that is crisp and direct as possible. And it has to be a specific number of ticks away, as few as possible from that 21. And ours is always giving you real readout, visible indication, letting you know how close it's getting to the 21 so that you know, is this condition being met? You always know, and you want that crisp direct pullback. 45 to 90 degree angle is optimum if you can possibly get it. Because the more rigorous you are, instead of chasing trades, the higher your percentage of winners will be, which is why more than 87% winning trades are what every single graduate I've ever had since 2018 have achieved. So with that being said, what is the third step? You want independent confirmation from that oscillator, either overbought or oversold. And remember, it doesn't put you in the trade when it gets out of overbought or oversold if it happens to do that. I don't care if it does it before you enter the trade. Once it's already gone in, it's satisfied step 3. All right. Now, step 4. It's going to depend on the chart you chose to enter on. Is it a 1-minute chart? Is it a tick chart? Because the average 2 range is going to dictate, oh my goodness, I can't use my NASDAQ 1 minute because the bars are just way too big. I'd better drop down to a tick chart, maybe a 144 or 233 are typical examples you might try out. Now, I promised you that I would tell you the risk levels that we use. What are they? If you're going to scalp on the indexes, our risk on a per contract basis, because I don't know how many contracts you are going to be trading, right? On a per contract basis, the maximum that you could lose on a per contract is only $70. It could be less. That's right. We don't use fixed dollar stops at all. That's so 20th century. We use variable stops. The size of the bar is going to dictate how big the risk is. So if you're in an uptrend and you park that stop limit order just before the bar finishes, 1 tick above the top of that setup bar, once the market goes through it and puts you in the trade, where does your stop go? On the other end of the bar, 1 tick under it. And vice versa if you're going to be going short. Does that make sense? I hope so. So that's why if the bar is big, the distance between the entry and the stop will be bigger, and so will your risk. If it's smaller, so will be the risk. Same thing for scaling out. Because we expect to go further than a simple scalp, we allow a greater risk level, up to, but never more than $100 per contract. All right? Are we all keeping up? Give me a yes. Let me know some of you are still with me on this. Type a yes in the chat window. I want to make sure. In the meantime, as I said, we don't use a fixed dollar stop. We use what are called logical or variable stops. Okay, great. Now, per contract, just a little final reminder on that. That's what we do, because I don't know how many contracts you might trade. You might be trading 2, 4, as many as 10 or 20. I don't know. It all depends on the size of your account. So here is a screenshot of a typical setup. Again, if you go to daytradesafe.com/replay, you will actually see the setups in progress in the presentation. So just follow along here on this static representation. The trend was down. It hit this lowest point. This is our 0 bar. And then we have a certain number of bars that have to be a minimum before the final bar that is the furthest in the pullback. Well, obviously, this red candle is the furthest in the pullback. It's not quite touching the 21, is it? But that is close enough to follow our rules, and we're calling that the setup bar. And assuming the other steps are fulfilled, step 3 would be overbought, and step 4 would be acceptable risk. What would you do? You would park your entry, a stop limit order, 1 tick underneath the bottom of this bar. Real simple. And let the market put you in, because this retracement, think of it as a rubber band. It wants to snap back in the direction of the trend. That's why we say let the market prove itself and put you in the trend. This next green candle did trade through what would have been the resting order right there. So you're in the trade. And then your stop would be up 1 tick above, as it says right here in the caption. You would park your stop 1 tick above where the arrow is pointing. So the distance between there and the entry is your risk, as I said before. And then all you got to do is wait to see if it hits your target, depending on whether you're scalping or scaling. Everybody got it? Oh, thank you, Dale. You're sticking around. Good to see you, man. All right, so what's next? Well, let me go here and recap this business of the order placement. Remember, don't chase the market with a market order. That's what amateurs do. Stop limit orders totally eliminate slippage. And by the way, make your target a standard limit order, because that also eliminates slippage. I want to be in control as much as possible. I want to eliminate all the variables that I possibly can. That is why I achieve the high degree of consistency in my system that I do. So, like I said, park that order if you're getting ready to get in, either a tick above or a tick below to go long or to go short. And I told you before, I tell you, when do you do it? Do you wait for the bar to finish? No, you might miss the trade. The next bar might already go beyond where you would have parked the order, especially on tick charts. So you, on a 1 minute chart, wait for the final 3 or 4 seconds. On a tick-based chart, because we don't know how many contracts are coming down the pipe for the next trade, I recommend, if it's normal order flow and it's not volatile, maybe 15 to 20 ticks just before it hits 0 on the tick counter. But if it's got higher volatility, you're going to want to get in earlier. That's going to depend on how much skill you have, eye-hand coordination, and experience. So I tell my students more detail on that in my coaching room, which, by the way, in my coaching room, I don't have hundreds of people, even dozens of people. I restrict it to just a very, very few people to give personal hands-on coaching. And everybody gets to talk to me anytime they want to. They can use their microphone, ask questions even in the middle of a trade. And furthermore, I do something nobody else does. I can look at you taking your trade and coach you through any problems you might have. That's right. I can see your charts and coach you right on through that problem. So let's keep going. As I mentioned, a pullback is nothing more than a stretch rubber band that wants to snap back and continue the trend. And that's what puts you into the order, through the order and into the trade. Okay, great. Now, here is a screenshot of once you were using this same pullback. I took that same order and made a screenshot and showed you the duration of a scale out example. On a scale out, you would have parked your order one tick below it, which would have been right there. And after you entered the trade, your stop would have been one tick above it. It's off screen slightly. And then you would have gotten into the trade. When you would have hit the target and scaled out, then all you had to do was trail your stop. That's what this is pointing at with all these arrows. These blue dots happen to represent the trailing stop indicator that I prefer. I've customized it myself so that if you've got a lot of momentum, it hangs back and gives breathing room so it doesn't choke off the trade. Notice when things started to go into a little bit of congestion here, that's what that little box represents. Notice how close it got. It almost took us out of the trade. We use a one tick offset, by the way. We don't put it right at the indicator. But eventually it came all the way down to here. And even with the one tick offset, the market took us out way down here. So that would have been close to $1,000 trade, about 800 and some dollars. So that is a typical example of what you can expect when you scale out, depending on what the market can give. I can't promise every trade will be that way. It's whatever each and every trade is going to offer you based on the market's capabilities, how many of those charts are trending together, etc. Okay, let's keep going. So once you're in the trade, I already told you it's automated. Keep your hands off the mouse. Don't you try to manage that trade, because then you aren't following a true system. You truly need to let the automation do it for you. Then you achieve real consistency. So let the system manage your trade and take you out. That way, even if you say, well, I would have gotten out here or there, I don't know why it chose this. Remember, that's just a sample of only one trade. Over the long game, the system has proven itself. How long? This system has actually had rules in effect that I have not had to change one bit for more than 20 years. That's right. This is not some fly-by-night, brand new, over-optimized, curve-fitted system. It is an extremely robust system, and I fully disclose the white box to all my students so you know everything about how it works and how the settings are made, even though it is automated. So what do you do when the trade is over? Wow, this is one of the most important things that a trader should be doing. You need to journal. One of the greatest traders that's ever walked the earth. His name is Ed Seykota. I don't know if anyone is familiar with his name. If you are, type yes, let me know. I invited him to our local trading group a few years ago. And at the very end, I raised my hand and I said, well, what are the most important things that will help me be a consistently profitable trader? He says, here's what professionals like me do. Number one, you got to have a mechanical trading system. You really need that. A Boolean logic, rules-based mechanical trading system, no subjectivity and no discretion. I'm going to get a swallow of water. Just a moment. Something got stuck in my throat. My goodness. There we go. I'm clearing it up. What is the second thing? Discipline. You absolutely must have diamond hard discipline. And being a psychotherapist, obviously, I'm going to help you with that. I have a very special tool that's included in our package that will help you forge diamond hard discipline. But what's the third thing? He said everybody needs to journal after a trade. The worst thing you can do is what amateurs do. They jump from trade to trade to trade, and they don't learn why it didn't work, and they are doomed to make the same darn mistakes over and over and over. You don't want to do that. You want to journal it. Now, I provide you with a pre-formatted journal so that it captures everything that you need to know, particularly things that are not part of the actual system. What is that? Anything that's not part of the system that you had entered is called context. For example, support and resistance. Now, even though our system will automatically plot all the levels that are significant for support or resistance, don't worry. You still need to consider other types of context. What might they be? Well, I'll give you a few more examples and then I'll wrap things up. You do not want to trade during a report. Going into a report, you need to make sure you're out of all trades. Don't trade the actual outcome of the report because it could go back and forth and stop you right out. So that's suicide. I had a student from Portugal once, and he lost 20-some thousand dollars on a single trade because he tried to trade the news. Don't do that. What else is context? Well, no trend lasts forever, even though we are a trend following system. Prices can get overextended. I show you what is a typical price move for the 1 minute, the tick chart, and the 3-minute chart, so that you know when it becomes overextended and the odds begin to drop, so that if you get a setup, the odds of hitting a target tend to fall. Another type of context you would want to put in your journal is, guess what? Volume. Now, we don't even use volume to enter a trade. However, if it drops below a specific level, and I'll give you one for example, I recommend if you're going to trade the indexes, you want to make sure that at least 200 contracts are being traded per minute bar. For the most recent completed 1 minute bar, if it has less than 200, be careful. You can maybe reduce your position size or change your exit strategy, maybe scalp instead of scale, something like that. But if it's below 100, stand aside. Don't even take the trade. Anybody got any questions? You can type them out. I'll be happy to answer them. And last of all, benchmarking. This is what professionals do. Benchmarking is a calibration process that requires your statistical tracker, which I provide, a fully macroed automated spreadsheet that lets you enter everything from which market performed the best, which chart performed the best, which exit strategy performed the best, and a host of other variables. Because benchmarking is extremely critical. You want to know how to achieve an authentic track record. That requires you, having journaled all the way up until then, taking every trade, regardless of whether you thought it was a winner or a loser, hopefully sim trading, because you don't want to risk money until you have that track record right. You would by that time know, oh, I've seen this situation before. I don't want to take that trade. Well, you need a statistically viable sample of at least 30 trades, and then you get to pick and choose what? The best of the best and leave the rest. And at the end of that, my students call me and we review what the spreadsheet said. Well, what's your percentage of winners? I have not had a single student, as I've said already, fall below 87% winners. And they did it all by themselves. They didn't do it with me. They did it by themselves. And several of them continued right on maintaining that and even improving that. So keep that in mind, that you will want to benchmark yourself. And if your track record starts to deteriorate, or you're going to try out a new market that you don't know anything about, you got to benchmark it first. You must calibrate yourself. What does that mean? It's your personality. I don't know if you're an aggressive trader I don't know if you're a conservative trader, but even if it's the same legal setup that all my students see, some of them want that trade, others don't want that trade based on their personal psychology. And this is how you calibrate yourself to the software, because you can't just buy it off the shelf and say, oh, all software behaves the same with all people. No, it does not. You cannot buy the stairway to heaven. So based on all the journal trades that you've done before, you know what worked, and this is how I'm going to help you reverse engineer what does work. And as I said, I haven't had a single student since 2018 fall below 87% winning trades. So I'm actually moving faster than I thought I would. So I've got a lot of time for questions, because before I move into the final close, would you please type out any questions you do have about whatever I have said, because I would love to answer it. Or if you want to just talk to me privately, remember, just send an email to support@daytradesafe.com and tell the support desk, hey, I want to talk to Michael. I've got questions for him, and they will provide you with a scheduling link that'll show you my calendar, and you can pick the best date and time that works for you. And I promise you, I don't do pitches. I don't hard sell. I never have. I've learned that doesn't work. I'll respect your intelligence and leave it up to you to choose what you think is best for you. So I'm going to go ahead and wrap things up here. The TradeSafe Trade Dominator system is what I've been talking about. And like I say, if you go to daytradesafe.com/replay, you'll get to see it in action, because we didn't have enough time today. So here is the link to getting our system. And if Sherry would please post this link, if she's back.
I'm here.
Great. That would be good, but it's pretty straightforward. It's daytradesafe.com/dominate, because that's what you're going to do, is dominate the market. And you're going to be able to get a very, very special discount. Now, I am not a believer, and I'm not disrespecting any other presenters today, but I'm not a believer in having people continue to pay for something. I want you to pay one time and it's yours for life. Consequently, this is a very comprehensive package with far more than software. My personal coaching in a coaching room, not a trading room. It's a coaching room. That's what it is. You are getting the statistical tracker. You're getting a business plan. You're getting a journal. You're getting a members area that is password protected with all of the training videos and information you need. You're getting the trend indicator that indicates trend and congestion. And you're also getting, oh my goodness, I'm leaving out 3 or 4 other things. You're getting a very comprehensive full-size package. And I've had people tell me that even at $29.95, I should be charging more, because they've made that back very quickly. But for you, I have a one-time special until midnight of next Wednesday. Then it goes up to $29.95 of $14.97. Now that still may be a stretch for some of you, but don't let that bother you, because I'm thinking of your best interest. I have a flexible payment plan that'll help you get started. Because remember, you don't have to start funding your account and starting trading right away. All you got to do is just join TradeSafe. Let me train you, and it is self-paced. And what will happen is this payment plan will give you a full 6 months to pay them back. And unlike the 25% interest on a credit card, you won't pay a penny of interest. How does that sound? And I've made that arrangement so that if you pass that real easy soft credit check, takes 2 minutes, then boom, you will have 6 months to pay them off. And once that's done, it's over. You will already be trading well before that and making money. So there's the link. So how about a few final questions before I adjourn?
Hey guys, here's your chance. Who has questions, please, for Mr. Michael Guess? And I have posted the daytradesafe.com/dominate in the chat. Michael, could you tell me again the email they should check in at if they need to talk to someone?
Absolutely. If they want to talk to me personally, the guy that developed this, it
Okay.
is Day Trade Safe. Oh, I'm sorry. Let's start over. It is support at daytradesafe.com. And she'll post that probably
Daytradesafe.com.
.com. Yeah.
Ask it to be routed.
And be sure and ask, hey, I want to talk to Michael. And remember, it's a no stress, no obligation type of call. I
Okay, and
have
there it
never
is.
pressured anybody ever.
All
Support
right,
at
guys.
daytradesafe.com. There you go, folks. Thank
There
you.
it is.
So I hope, folks, that you feel your time was well spent on this, because remember, ask yourselves, if what you've been doing isn't working, do you want to just keep doing that over and over? Isn't that what Einstein said is the definition of insanity?
Yes.
And I am
You're
going to
right.
give you something that I have proof from actual students and testimonials that can say you're going to be hitting it out of the park, folks. So I want to say thank you very much, and especially to Sherry and Traders Exclusive. Thank you very
Thanks.
much. Bye-bye.
Thank you. Many thanks to our sponsors for the June live trader showcase, Market Taker Mentoring, TechniTrader, and Money Mentor. Please go check them out at markettaker.com, technitrader.com, and moneymentor.com. Thank you again.